was supposed to start us in a word. Good morning and welcome to Business Matters Talk Show. We discuss the matters that affect your business because your business matters. Good morning, Tallahassee. This morning we're joined by Steve Hogan of the Ausley Law Firm, and we're going to talk about sales tax. Last week, if you joined us last Sunday, we talked about sales tax, the sales tax audit, the effect of Amazon purchasing goods and services or goods online, and the effect of the business owner. When you do that, they still have to pay the tax, even if they don't pay sales tax to Amazon or whoever that online purchaser is. So we ended the show last week talking about the business owner receiving a notification that they're going to be audited. So let's continue that and what the process should be. I think you ended the show saying that the first call they should make is either to their CPA or to their tax attorney. And the reason, if I remember correctly, you said that how you start the audit could impact how the audit ends. So you want to make sure that you do all of the steps initially correctly to make sure that puts you in the best position possible to reflect what you did, what your records show, and how to present that to the sales tax auditor.
Absolutely, and hopefully in the last week, none of our listeners have gotten an audit notice from the DOR. But if they did, hopefully they called somebody.
I hope so.
Because here's what happens, and I sort of I'll repeat myself a little bit from last week. But if a business owner gets an audit notice and they don't call a professional, that's a repeat player with the either the IRS or the Department of Revenue. We're talking about DOR right now. They're not going to see they're not going to know. They'd have no reason to know what pitfalls to avoid. And when you call a professional in, then you have somebody that's been through it before and can steer you correctly. Now, when I love it when clients call me when they first get an audit notice, and I don't love it because, hey, I can
notice, and now you have.
I can work this file throughout the audit. No, right. It ain't like that. It's because you can make it clean from the start.
Right.
And it's most of my cases as a tax lawyer come to me after things have totally gone wrong. After an audit has happened, an auditor has misunderstood the business and has come out with a tax assessment for $100, $200, $300, $400, $500 plus $1,000 against a business.
And so when you normally get the case, when you get the call from the business owner, is after they've already submitted their first round of documentation to the sales tax auditor, they get a reply from the sales tax auditor that says you owe a lot of money. Then the business owner says, I need to call Steve.
Hopefully, in the best world, they're all calling me. But yes, we've been doing this a lot, and there's things that I can do in my entire business, really, in that arena, is fixing things after they've gone wrong. But when I get involved early in an audit, I can avoid those things from going wrong in the first place. And a lot of it has to do with, as I mentioned earlier, the auditor not understanding a business.
Right. Because,
you know this, Charles, and I know this because, I'm a tax lawyer. But if you're not in the tax world, you may not appreciate this. Here's what I'm talking about. When most people think about tax laws in general, okay, at least from my experience, what they think is, well, it's clear. Stuff is either subject to a tax or it's not.
Right.
But as you and I know, that's not true.
That is not true.
Most of the time, we're swimming around in gray area.
Yeah.
Both at the federal and at the state level here in Florida, and other states too, but we're talking Florida.
And I found that the state tax laws are very, very complicated, even probably more so to me than the IRS regulations.
Well, it's interesting you say that because it's just as complicated a set of statutes and concepts, but the thing that you have at the federal level that you don't have at the state level is you have, the federal level impacts, 200 million people. The Florida tax code only impacts like 20 million people.
Right.
So you are going to have, when your laws affect 200 million people, you're going to get a lot more guidance.
True.
From the IRS, you're going to get a lot more cases, not litigated court cases. But you're going to get people asking for private letter rulings at the federal level and all sorts of other stuff. Agency guidance, field service advisories all around the country. There's just a lot of stuff there. So if you have a question about your federal issue, you can usually find some kind of answer. But on the Florida level, and this is true in other states as well, if you have a question, odds are there's no answer.
So you may be asking the question the first time, or there's no documentation to go back to rely on.
Or the question has been asked and answered many times, but nobody's ever written it down.
Okay. More likely.
My mentor in all things tax is my law partner, Bob Pierce at the Ausley Law Firm, and he was the very first general counsel that the Florida Department of Revenue ever had. And it's better now, but it used to be for a very long time.
Bob is not that old now.
No, Bob's not that old, but he kicks back when he wants to. But he's trained me well. But most of Florida tax law was like voodoo and rumor. You just kind of had to know what the people at the agency thought was the law, and this maybe sound horrifying to the people listening, because what do you mean there's so much gray, but there is. That's why tax professionals exist. All of that, which is to mean that an auditor may look at your business and say, this looks taxable because of X, Y, Z, right? Mm-hmm. And if you're the business owner, you're saying, what are you talking about, right? And the auditor says, it's taxable because X, Y, and Z. Boom, assessment.
Right.
Now what are you going to do? But if you have a tax professional in there, they could say, no, auditor, you're looking at this as being taxable because of X, Y, and Z. X and Y don't really apply to this business. Z does, and we're doing Z correctly. X and Y, that's a different kind of business.
Perfect.
So that's the issue. That's understanding and misunderstanding a business.
Now, if you're just joining us, you're listening to Business Matters on Real Talk 93.3. We're joined today by Steve Hogan of the Ausley firm, and we're talking about sales tax and how sales tax affects the everyday business owner, the everyday business, and even the consumer. So we're talking right now about the process of an audit.
Right, and the biggest issue is an auditor misunderstanding of business. That's where when people say percentages, they're just making something up, right? Approximating a gut feeling.
Right.
But I would say that at least 80% of the problems in an audit come from misunderstanding of business. And I'm thinking specifically of several audits that I'm not going to tell you any details about.
Good.
But that's the whole issue, in the whole dang thing. And so that's my job at the start of an audit and all the way through it.
But that's why it's important to make that call initially, because a lot of times you probably see the direction that the auditor could misunderstand that business purpose or how the business operates, and you can direct away from that misconception.
That's right. And another important thing is to understand the way that the Department of Revenue engages with a business's records. Right. Because what you'll get at the beginning of an audit is a request for, often these days it's an information form asking how you even keep your records. What records do you have? That seems straightforward, but you want a professional looking over your shoulder. And then from there, that generates the records requests. Now, the state has the power to say, give me all your stuff, right? Mm-hmm. And you got to give them all your stuff, right? You got to give them access, right? I mean, there's no, defense. Like, you can't just pound the table and say no.
Right.
If you do, then you've essentially broken the law, and not that you're going to go to jail for that, but you're going to get a big assessment at the end of the day. So you got to cooperate. But the way that a business keeps its records matters. And if you have a lot of records, and if you're a retail sort of business with a lot of small transactions, you're going to have a lot of records. These days, a lot of it's electronic, but sometimes it's not all electronic. So it's a process of negotiation about at the beginning about, all right, here's what our records look like. This is what we have. How do we want to do this? Because the auditor really, and I always approach it this way, is somebody with a difficult job that's just trying to get things right?
And they usually have more on their list to do than they can do anyway.
That's right. And if you make their job easier, then, that's going to be good for you, right? And I'm not, saying sucking up. I'm talking about treating somebody like a professional and not like an enemy, right?
Yeah, the deal is you have to go through that audit whether you like it or not. Mm-hmm. So you need to do it in a cooperative manner, and to try to negotiate where you need to negotiate, and use your tax attorney or your CPA to help you with that.
That's right. That's right. And of course, you're a CPA. I'm an attorney, and we've gone through this, and we help clients with this, right? But it's not just hey, call, have you hugged your tax attorney today?
Right.
It's we've seen things go wrong,
Absolutely.
go really really wrong,
Right.
and this is why you put a seatbelt on when you get in your car, right?
That's right.
So that's what we're talking about.
Trust me, I do not like to spend clients' dollars or my dollars when it comes to matters like that, but it's critical that it helps you defer or not to pay dollars that you don't need to pay.
Absolutely, absolutely. And there's a lot more to say about that, and hopefully we can come back around to it soon, because how you deal with those records can determine the course of an audit.
Well, good, Steve. This is we're continuing along the audit process for sales tax and the Department of Revenue. You're listening to Business Matters here on 93.3 Real Talk. Come back after the commercial break, and we'll continue this discussion, and then we're going to get into sales tax related to real property rental. So join us after the commercial break. This is Charles Musgrove with the Beam Team. Welcome back. You're listening to Business Matters. I'm Charles Musgrove with the Beam Team, and we deal with many different issues. And today we're talking with Steve Hogan of the Ausley firm about sales tax. Steve, let's finish up with the audit process that the business owner may go through, and then I'm going to jump into commercial leases and the potential liability there with sales tax.
Sure. To preview that, the fact that you may have a commercial lease without a lease.
That is true.
And we'll talk about that in a minute. But so we were talking about records when we left off there, and the importance of understanding what records you have and what they mean in an audit is closely related to the department's sampling methodology. Now, the department could audit your business by looking at every single record of every single transaction, seeing if you collected sales tax correctly on every single one.
Not a sample. They're just going to look at all of them.
Those look at all of them. They certainly could, right? And if you're a business without a whole lot of volume, maybe that makes sense. But most businesses, and let's say most retail businesses anyway, that are selling a high volume of products, that's just not practical.
Not practical.
So the department has sampling methods that they use. They have a random number generator, essentially, that picks different periods in the audit. Normal audit period is 36 months, 3 years. Mm-hmm. So they'll normally pick 2 or 3 months with a spare to say, here, these are what we're looking at to pull some records. And depending on the volume of the business, you may even want like 1 week in a month,
right?
If it's super high volume. But the issue there is, well, are the periods that are picked for the sample actually representative of the business's transactions throughout the year?
Right.
And if you have seasonal businesses, that's a big issue, right? If you're tourist dependent, then your sales are going to look a lot different in July than they look in September.
A restaurant in Destin, Florida is going to be busy in July. They're not going to be busy in December or January.
That's right. Spring break week is going to be, or season, I guess, is going to be bonkers, but, the middle of December, forget it.
Right.
Right? So, it's important to work with an auditor, with your tax professional, to pick the right sampling period that is actually representative of a business. And when I'm dealing with that with a client, one thing I always try to suss out if possible is, all right, do you have any problems that you know about in these sample periods?
Right.
Because maybe it's we were talking about use tax on a previous episode, I think.
Right.
And we were talking about, did you pay use tax on this stuff that you bought online? Well, if you bought like a big piece of equipment within the sample period and you didn't pay sales tax on it, you certainly want to have that dealt with individually and not as part of a statistically averaged sample of your error.
So, for instance, if you did re-equip your restaurant in December and you bought all of the goods from another state, then that's not going to be representative of the rest of the year.
That's right. And the reason that matters is because the sample period is used to create what they call an error ratio. Error ratio. I hope I said that clearly.
Error ratio.
There you go. And they say essentially, all right, we found these errors in the sample period that comes up to X percent of of the transactions that we looked at. And so we're going to use that through a mathematical formula to create an error ratio. Now that we're going to multiply that decimal by all your sales for 3 years, and that's the tax you owe.
Right.
So you want that error ratio as low as possible. So that's why I say if you know you have one big transaction or one big problem, maybe 2 big problems, hopefully not more than 2,
Right.
within the sample rate. You got more than 2 big problems, you probably have a lot more problems.
You may have a problem.
But you want those taken out, and you can usually negotiate that because you can deal with those. Yes, I know I owe a certain amount of tax on that. That was an error. I'm sorry. I'll fix my process so it doesn't happen again, but let's not put that in the error ratio. That's going to save you money.
Well, good. That's you're listening to Business Matters on Real Talk 93.3. Steve, we're going to leave the audit process there, and let's jump over to the lease and the rental situation where it could be related party transactions, so that a business owner, they may have a business that rents a building from himself. So he has a building that he owns in another entity, or either owns it individually, and he pays himself rent, or he just say that he pays. Here's what could happen very easily when you said there's no commercial leasing process in place. If that business owner owns the building individually, and he has the business pay the mortgage on that property.
That's right.
So walk me through that, and let's talk about, is that a commercial lease in place? How is the Department of Revenue going to look at that?
Well, this is a really important issue, especially in Florida, because the last time I looked at this, and I wrote an article about this actually, that you can find at my law firm's website. Every dang article I've ever written is on my profile at ausley.com. That's AUSLEY.com. You can find my attorney profile there. Hit publications, there's too many.
That's a lot.
But there's too many. But there's one specifically on this issue.
It's a very common issue.
Oh, it is. So let's set it up here. So first off, the last time I looked at this issue, which maybe a couple of years ago, Florida was the only state in the union that had a tax on commercial leases. Did you know that?
I did not know that.
Yeah. I mean, New York City does, because New York City's weird. But
they tax everything.
Yeah, they tax everything. I mean, oh my goodness. People talk about Taxachusetts, for Massachusetts, it's New York City. But so Florida is unique in that regard. And what you have is a tax on commercial leases, not residential leases, okay? So when you rent a house, you wouldn't have paid tax on it normally, unless it's like a short-term rental, and then you're in the hotel rules, right?
That's right.
So, so many people may not have experienced this unless you're in a commercial context. But if you're a business and you're renting property, let's leave related parties aside for a moment. If you're a business and you're renting space, then you should be paying tax on that rental. Your landlord should be collecting tax from you. If your landlord is not collecting tax from you, you need to ask some questions, because when you get hit by that audit notice, it's a weird thing in Florida law. But even though your landlord should have collected the tax from you, if you're if you're a tenant and you're paying on a commercial lease and you're not paying tax, and you can't prove that you pay tax to your landlord, guess who owes the tax?
You do.
You.
The tenant.
The tenant. And that is a big surprise.
Wow.
Like, what the heck in an audit?
So the landlord gets off scot-free in that situation.
Potentially.
Wow.
Maybe you could sue him. If you could prove that you paid the tax to him.
Right.
Yeah. So it's an issue, right? So let's take for granted that all commercial leases are taxable, okay? And the normal lease between the tenant and landlord, non-related parties, you're going to have a piece of paper that says, what the terms of the lease were. Who would do it otherwise, unless it's like your friend.
That's right.
But even friends are going to write down. So that's the normal situation. You can understand how that's taxable. But the ambiguity comes when you get this a lot with doctors and similar professional organizations, where you have the people that perform a business, that do business operations in a spot, in a place, in a building, that also own the building or own the land or own the land of the building, right? And they have that professional organization, the entity, that
That's the operating entity.
Yeah, that's the operating entity. Sorry, I lost myself for a second. So the operating entity, the business may be in one entity, and the business, the same people may be the same partners in another business that own the building and the land. That's a very common setup.
Which that's smart. That's good liability protection to have the
That's
building
right.
assets separate from the operating entity.
That's right, because if somebody sues your operating entity, you don't want them to take your building.
Right.
Right.
So when you do it correctly from a liability protection standpoint, then you create the potential sales tax issue when it comes to servicing the debt or paying the rent over to that other entity.
That's right. That's right. And it gets complicated because when you've got money flowing between the operating entity and the entity that owns the land, and they're both owned by the same people, it's not like you want to make a profit off of yourself, right? So you may just be transferring money to cover the expenses, to, like you say, cover the mortgage, cover the taxes on the property, whatever it happens to be, to pay the utility bills, whatever. And if that looks like rent, okay, and I hate to be that vague, but that really kind of is the standard. It's a facts and circumstances test, which means that if it looks like rent, then it's probably rent.
They're going to call it rent.
They're going to call it rent if you get audited.
What if the operating entity pays the property tax?
That's rent.
That's rent. Somebody owes sales tax in that situation.
That's right. It's not to be too long about this, but if you're the tenant and you're paying the taxes on the property taxes on their property, that payment is taxable rent.
Correct. Steve, that is, I don't know if that's good news or bad news, but that's information that we need to know as business owners, as regular consumers out there, as tenants. Thank you. Man, that is, I hate to say that, but it's good and bad. Thank you for sharing that information. Thank you for joining us on this section of Business Matters on Real Talk 93.3. I'm Charles Musgrove with the Bean Team. Join us next week, 11:30 a.m., 93.3.
Thanks, Charles.
Good morning and welcome to the Business Matters Talk Show. We discuss the topics that matter to your business because your business matters. I'm Charles Musgrove with the Bean Team. We're an accounting firm that specializes in accounting and tax. We also help resolve many other business issues. Today we're going to continue our discussion with Steve Hogan of the Ausley Law Firm, and we have had 2 other shows that deal with sales tax. There is just so much material there that we're going to continue that discussion. And today we're going to talk about leases, commercial leases, and particularly when it comes to related party commercial leases. There's a lot to discuss there. This is a topic that is real time. I see this so frequently in businesses where the operating business rents property from another entity that's owned by the same people that owns the operating business. And a lot of times what will happen is that operating business may pay the mortgage, they may pay the cost associated with but just owning that property. For instance, they may pay the property tax for that property. Even though there's not a commercial lease in place, does a
written commercial lease?
A written commercial lease.
It could be a lease.
That's right. So I think what you just said before, if it looks like a lease situation, then it probably is, whether there is a written lease or not. So what happens in those situations, and how does the Department of Revenue look at that?
Sure. And Charles, thank you for having me back on. This has been a great series of discussions here. With this particular commercial lease issue, we talked last time about the unique fact that Florida has a tax on commercial leases like no other state does.
Right.
And at least the last time I looked it up.
That's crazy to me. I never knew that.
Yeah. I thought that was the case, but when I wrote the article that I referenced, which people can find at my law firm's website, that's ausley.com, AUSLEY.com. It's on my profile under publications. So that was written maybe a year, maybe 2 years ago. But I thought it was the case that Florida was unique in that, but I had to look it up, and I looked it up, and I was right. So Florida is an outlier there.
Wow.
So there's tax on commercial leases. Now, what is the tax on? Because that's really what we're getting to. Okay.
That's right.
You know, it's one thing to conceptually have in your head. All right, so you've got operating entity that runs the business, that is the business. And then you've got the property holding entity, maybe owned by the same people that are doing the business. You see this with doctors, medical practices a lot. That it's the same folks, but you know it's a different entity that owns the building. You know, one may pay these expenses, those expenses related to the property, whatever. So you can see how because you have two entities, one is occupying land that's owned by the other entity. How a commercial lease can be seen to exist there if there's money going back and forth. One entity paying the costs of carrying the property for the other. Okay, that's how you get a lease. Okay, so but what is taxable? What is taxable is rent. Okay, so the question is, what is rent?
The amount of rent. That's the key, right? The amount.
Well, let's go more theoretical.
Okay.
What is rent? Okay, because rent is it's like we all sort of think we know what rent means, and it seems like a simple concept, but as is the case of most things in sales and use tax, it's the details that really matter. And the statutes and the rules talk about any amount that's paid as consideration for occupying the real property. Okay, so it's any amount that is consideration. That means something that is required as a prerequisite for occupying the real property. So there can be other expenses that aren't consideration for occupying the real property, and those other things, you know, may not be rent. You know, you might have
mowing the lawn.
And you know, those ongoing maintenance costs, you know, utility bills. Your landlord doesn't care about utilities. It's like, pay him if you want to get them.
Right.
You know, I mean, that's not rent, but it could be rent. You know, if the landlord is on the hook for utilities and they say pay the utilities, it could be rent depending on how that lease is written.
Right.
You
so
know?
The key in that is the lease. That's the governing document.
Right. And if there's no governing document, then you're just adrift in the gray. What is rent? What counts as consideration? And so if you're in this situation, okay, if you're in this situation as a business, the question should be, oh shoot, what do I do?
Right.
Okay, and your tax professional, your tax lawyer, CPA, have you hugged your CPA lately? Can walk you through this, and there's normally a two-step process that I've used to fix this problem.
So the problem initially is that you've got an audit situation or Department of Revenue situation. The second is, do you have a governing document?
That's right. Let me define what the problem actually is. Okay, so if you have a situation where you have related parties that there's probably should have been a written commercial lease, but there isn't. There's stuff that looks like rent payments going back and forth. Well, that should have been taxed and wasn't. What's the real issue? Well, issue one is you get audited by the Department of Revenue, and now you have 36 months of liability. Okay,
right.
That's one issue, plus penalties and interest. Okay, but the other issue is you owe tax in the state of Florida, and you're not paying it.
That's right.
So it's not like you don't owe tax until an auditor says you do. You actually owe the tax.
You owe the tax.
You do. So what do you do about it, right? Because the normal statute of limitations is and that's the period in which the state can come after you, is 3 years. So that's 36 months potential liability hanging out there.
If you are just joining us, you're listening to Business Matters on Real Talk 93.3, and we're talking today about commercial leases between related parties and the pitfalls that you may be in and you not even know it. So we're talking about does a lease exist? You still owe sales tax to the Department of Revenue to the state of Florida. Steve, continue that discussion.
Sure. So what do you do about it? Okay. So in the audit situation, well, the way you deal with it is you negotiate with the auditor and you try to, fix things going forward. There's not much you can do about that. And then you argue about what's rent and what's not rent in order to get the number as small as possible, right? That's how you deal with it if you're under audit. If you're not under audit, what do? Right? Do you just float around with this liability?
You don't hope.
Yeah, you don't hope. You don't hope. I like that. So here's what I normally do. when a client comes with this particular issue. It's a two-step process. Step one is get a written lease in place. Now, why is that important? Because in a written lease, you can define what rent is. And
so you can be proactive.
You can be proactive. You can define what counts as rent and what doesn't. And an auditor isn't there telling you, or you don't have the risk of an auditor telling you, well, I think this is rent, I think this is rent, I think this is rent.
Right.
You can define it, right? And you can define the amount of rent. Now, technically, you can define it as low as you want. You can define it as 1 penny for this 20,000 square foot, manufacturing facility.
But you're going to have to defend that as well, right?
Not really.
Not really?
No. Okay. That's technically, okay? That is just asking to have problems, okay? So whether something is technically correct and whether it's defensible in the real world are two different questions, right? So technically up in the clouds, probably, the way you read it, but in reality, you're you're not passing the laugh test and you're going to have problems.
Right.
So do we want to give our clients problems?
No.
No, we don't.
We want to solve problems.
We want to solve problems. So what I normally do is have them estimate a market rent. It can be as low as possible. It can be, what the lowest of the low property or square foot rental is in your particular community. But whatever it is, you can make it low, but it's written down.
Right.
Therefore, you know what the rent is. So you're covered going forward, and then you start collecting and remitting. Okay?
So even though it may cost $5,000 a month to pay the mortgage, pay all of the costs associated with that building, the rent could be defined as a lower amount, and it's still supportable.
Yeah, tax law doesn't care if the landlord is losing money.
Right.
Right? They don't, right? The tax is on the amount of consideration for the right to occupy that real property.
So if you compare that to if I have a lease versus I do not have a lease, if that operating business is paying the mortgage for that property owner, then the Department of Revenue is most likely going to say that full amount that you pay as the mortgage is consideration for rent.
That's right. Who wouldn't? Right?
Exactly.
So that's step one, and that covers you going forward. But step two is, what do you do about all this tail liability, 36 months or more, technically.
Right.
Because if you should have filed a return but you didn't, then technically you have endless liability. But practically, it's 36 months.
Right.
So what we do is there's a process with the Department of Revenue called voluntary disclosure. And that means that you can come proactively to the department if you haven't gotten an audit notice. Tell them, you know what, I had a problem. Here's how much I think I owe for the last 36 months. Here's a check. I've fixed it going forward. Please waive penalties, and could you, do me a favor on interest too?
Yeah.
You usually get penalties waived if you do it correctly. Not so usually on interest, but it doesn't hurt to try.
One good way to think of interest is you got the use of that money for that time period, so don't be so heartbroken over paying the interest. If you get out of the penalty, that's a victory.
That's right.
So another great session about sales tax. Steve, thank you so much for joining us and giving us the knowledge we need to have to properly prepare ourselves for payment of sales tax, prepare that operating lease, and put yourself in the best position to go forward with doing best business practices. Thank you very much for joining us. This is Charles Musgrove with the Bean Team. You've been listening to Business Matters on Real Talk 93.3. Join us next week, Sunday at 11:30 a.m. here on Real Talk 93.3. Welcome back. You are listening to Business Matters. We discuss the topics that matter to your business. I'm Charles Musgrove with the Bean Team, and today we're joined by Steve Hogan of the Ausley Law Firm. We are talking about sales tax, how they matter to your business, and we want to jump into another topic around sales tax, and that is, how does the business that sells in multiple states, how do they report sales tax? What is their responsibility? And before we get into that, what's the current law? What's the current position? Give us a little history, Steve, on what's happened in the past, how companies used to have to deal with paying sales tax in multiple states that they may sell to the end consumer.
Sure thing. Thanks, Charles. This is an issue that is recently important to every business in the country. And tax nerds have seen this happening.
Present party excluded. Included.
There you go. But a lot of businesses still don't realize that they might have a problem. Now, what's the problem? Well, let's talk about it generally. We've talked in the past, you and I have on this show, about online sales, right? Buying things online, mail order, that sort of thing. We talked about it in the context of, all right, I'm a business and I'm buying something online, I'm buying a mail order, and my vendor may or may not have charged me tax. And if they didn't, what's my liability to the state of Florida for use tax?
Right. So that's from the standpoint of the purchaser.
That's right.
So we want to deal with the business that's selling.
Right. And it's related, because the question that one might ask is, why haven't all of the companies that I bought stuff from charged me tax?
Right.
Why have only some of them done it? And why do some charge me sometimes and not others? Right?
Good question. That happens.
That's right. And the reason was, and you got to wind the clock back a little bit and talk about the federal Constitution, the Constitution of the United States of America.
Good place to start.
Well, for this, it's a constitutional issue, right? So if we travel back in time to the 90s, the 1990s, you had a case called Quill Corp versus North Dakota. And that case went all the way up to the U.S. Supreme Court. And the issue in that case was whether or not the state of North Dakota could force a company that was selling things through catalogs, the mail order catalogs. They were selling office supplies, Quill Corporation. They're still around, I believe. They were sending catalogs into North Dakota and selling office supplies and that sort of thing. And the state of North Dakota said, well, wait a minute, you're selling things into our state, to our people, but you're not, doing the sales tax thing. What's up? So that's what that case was about.
So they wanted Quill to collect the tax for them, and so they could get it remitted to their state.
That's right. Just like if Quill was located in North Dakota, they'd be doing the tax thing just like any other North Dakota business.
Right. Makes sense.
So it went all the way up to the U.S. Supreme Court, and the U.S. Supreme Court held that based on constitutional principles of that are esoteric, we don't really have to get into, that if a business was not physically present within a state, if they did not have a physical presence, then that state could not force the company to collect or remit sales tax on its sales to state residents.
Brick and mortar.
That's right.
Brick and mortar.
You can get a little bit weird about what's physical presence and what isn't, but that's a discussion for another time. Okay, so take for granted that if you're a business without physical presence in a state, then under the way it used to be since the 90s, that state could not force you to collect and remit tax on your sales. Okay, that was in the 90s. The internet commerce was not that big a deal in the 90s,
right,
as those of us that were, sentient human beings in the 90s can attest, right? And what a couple things happened. One thing that happened is that in the early 2000s, people will remember that the economy started nosediving down,
right,
and state tax revenues nosedived at the same time that e-commerce was exploding. Right?
And the states were looking for more revenue.
That's right. And so states looked at this Quill decisions like, this is a roadblock to this, and our in-state businesses are losing revenue, yada, yada. So there was a lot of effort put forth at the state level, 50 state level, to get around Quill, okay? Mm-hmm. And it bubbled up in a series of cases, and the most recent one was the case of Wayfair. Wayfair versus the state of South Dakota. Actually, it was South Dakota versus Wayfair. The Dakotas loom large, it says, yes. So that case came through the U.S. Supreme Court last year, and it changed things completely.
Wow. If you are just joining us, you're listening to Business Matters on Real Talk 93.3. I'm Charles Musgrove, joined by Steve Hogan of the Ausley firm. Continue that discussion on the Dakotas and the impact that it's had to sales tax as we know it today.
Sure thing. So if you look at the old case, Quill, as creating a safe harbor, okay, that which means that if a business did not have physical presence within a state, then that state could not force it to collect or remit tax, okay? They consider that a safe harbor.
So South Dakota or North Dakota lost.
North Dakota lost in the Quill case. Well, South Dakota won in Wayfair last year.
Wow, just
And
last year.
Just last year, June 2018. And what that case did is it blew up the safe harbor. It exploded it
Wow.
and said, Quill, which was Quill, the old case that was based on the federal Constitution. Constitution hasn't changed. The law is different now. Okay.
The interpretation, right?
Well, welcome to constitutional law. It's the most frustrating class I ever took in law school. I can't stand federal constitutional law for that purpose. You know, it's like they say, oh, the law is different now. It's like, why? Oh, because different people are making the decisions.
That's true.
You know, and then anyway, I'm not going to get off on that tangent today, Charles.
Thank you.
And you can't make me. All right.
Don't do it.
So the Wayfair case blows up the safe harbor. So what does that mean now? What that means is that if you are a business and you're selling things online, which most businesses do, you may have a 50-state tax problem.
Wow.
You may owe sales and use tax on every sale that you make, no matter where it goes. You know, is it going to California? Is it going to Kansas? Is it going to Massachusetts, New Hampshire? You may have a tax problem in every single one of those states. So what do? Well, what you do is you call your tax professional. And your tax professional walks you through it because these things change every day. Now, what did Wayfair do? Wayfair said that South Dakota's law was constitutionally fine. And what did Wayfair's South Dakota's law say? It said this, that if a company with no physical presence in the state of South Dakota had 200 sales within a year or $100,000 worth of sales in a year, that's or, you know, not both, just
right.
Or. So if you sell big machines, there'll be one sale.
Right.
Then you have constitutional nexus. Nexus is the key term with the state of South Dakota, and you have to collect and remit tax on those sales. So what the U.S. Supreme Court said is 200 sales or $100,000 is enough to satisfy the federal Constitution.
That's huge.
It is huge because, like I say, if you're selling heavy equipment, well, now you may have a problem every time you sell a piece of heavy equipment. If you sell small dollar equipment, but a lot of them, like, fishing flies, okay, you may have a 50-state problem.
Right.
All right. And what states have done is they have not all adopted the South Dakota standard because what matters for your tax liability is what that state says is the standard.
So it's a state law.
It's a state law, right? It's a state law that's got to pass federal constitutional muster.
Right.
All right. It's the Wayfair case. And if you really want to geek out on this, you can go to my law firm profile at ausley.com. That's AUSLEY.com. And hit my publications tab. I've got at least one, I think maybe two, but at least one article that I've written about this that you can get there. So a company is going to have to monitor the nexus standards in 50 states. Now, those change a lot. And I've had to do this for clients, and you have to actually look at every single state, and they shift and change a little bit. Software is coming along to help with that, but still, it's something that businesses have to look at and take seriously.
One thing I said before about sales tax, it's very complicated, and you just underscored that again. Now it's complicated times 50.
Literally.
Though
some states don't have a sales tax, so man, complicated times 48.
Right, 48. Steve, thank you so much for joining us on Business Matters. I'm Charles Musgrove with the Bean Team. Join us every week at 11:30 a.m. on Real Talk 93.3 for Business Matters.